Here's something insightful value just couldn't ignore. Carter's stock is trading near multi-year lows, and barely anyone's talking about it. Is it a value trap or a quiet opportunity hiding in plain sight? If you're into real-world investing, this one's worth a few minutes. This review is for informational and educational purposes only, not financial advice. Hit that like button and subscribe if you want more no-fluff company breakdowns like this. Carter's is the largest branded marketer of baby and young children's apparel in North America. You've seen the name in almost every major retail store: Target, Walmart, Amazon, and of course their own stores. The company owns strong brands like Carter's, Oshkosh B'gosh, and Skip Hop, making it a household name for parents shopping for quality at scale. But despite that familiarity, the stock is down significantly from its highs. Investors are cautious, and for good reason. Consumer spending on apparel has been inconsistent, and Carter's is especially vulnerable to economic slowdowns that hit families with young children the hardest. Revenue in recent quarters has declined, and full-year sales in 2024 are expected to be lower than in prior years. Earnings per share have also taken a hit as the company deals with higher labor and input costs. Still, there are reasons not to write it off just yet. Carter's continues to generate solid free cash flow and pays a dividend with a yield above 5% at current prices. That's pretty generous for a company in retail. In fact, they've increased the dividend steadily over the past decade, showing a commitment to returning value to shareholders. They've also been buying back shares aggressively, which can help support earnings per share in the long run. From a value perspective, the stock is now trading at a price-to-earnings multiple that's well below its historical average. Profit margins have been under pressure, but the company's long-term operating margin still hovers around 10% in better times. The balance sheet is healthy, with manageable debt and good liquidity, but the risks are real. Carter's is exposed to the ups and downs of the retail cycle, and they've been seeing softer foot traffic in stores. Online competition is heating up, and they'll need to invest in digital channels to keep pace. There's also a long-term demographic trend of declining birth rates in the United States, which could limit organic growth. So why invest now? If you believe that Carter's brand strength, supply chain, and omni-channel strategy can weather the storm, the current low valuation might look attractive. But if you think structural challenges, like shifting consumer behavior or slowing birth trends, are too big to overcome, you might want to be cautious. Dividends have been a bright spot. Even as earnings dipped, Carter's has continued to pay, and even raise its dividend, signaling long-term confidence from management. The payout ratio has crept up but remains within a sustainable range. Recovery? It depends on how soon consumer confidence rebounds and whether Carter's can adapt quickly. If inflation cools and families return to spending more on kids' clothing, the stock could see a decent upside. At Insightful Value, we dig into companies like Carter's that may be overlooked or misunderstood. We simplify the complex, filter the noise, and focus on what actually matters for long-term investors. More insights on Carter's and other undervalued stocks are available at insightfulvalue.com. If you're finding this analysis helpful, make sure to subscribe and like the video. It really helps the channel. See you next time.